One of the companies that's made a massive turnaround over the last few years is Uber. Not only has the company taken a clear lead over its biggest competitor, Lyft, and then ancillary competitors like DoorDash, really consolidating the power in that delivery market, it's also made a massive transformation on the bottom line. Now, there are a number of reasons for this. Not only has revenue improved, but margins have improved as well for a huge reason, and that is the amount of money that Uber takes from each delivery has gone up over time. Now, this is a fascinating dynamic, but it really shows Uber's power in the market. And that's what I want to dig into today is why this company has done as well as it has over the past couple of years, and then what to look for the future, because I don't see anybody disrupting them anytime soon. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. Go to fool.com/ASYM for their top 10 stocks to buy right now. Now, I want to start this with a couple of charts that I think show the story for Uber and exactly what's happening with the company. The first is Uber's revenue chart. And a couple of things to note here. First, you can see that there's obviously the dip during the pandemic. That shouldn't be a huge surprise. Obviously, people weren't traveling as much, even going to work, but there was ordering food. So they did survive. They were able to kind of transition some of the business to that delivery business. But since 2016, revenue has grown at a compound annual growth rate of 39%. So just a phenomenal growth rate for a company the size of Uber. The next thing I want to look at is exactly where that revenue comes from, because this really tells the story of the last few years and then where there has been the most success for Uber. So you can see if you just look at the long-term trend line for the mobility business, which is the traditional transportation business for Uber, that has been growing steadily for more than a decade, but it's essentially linear growth. It's not really a compound growth engine. They're adding some markets. Maybe it's a little bit more convenient, but not a massive growth market. Compound annual growth rate is 17.5%. So impressive business, but not necessarily the growth driver for the company overall. The two areas that they're growing much more is in delivery revenue. This is in particular delivering food, so things like Uber Eats. And that has been growing in a compound annual growth rate of 69%. Business that basically didn't exist in 2017 and now is generating over $12 billion a year in revenue on a trailing 12-month basis. Now, the freight business, something that I think that we're probably going to see them continue to de-emphasize over time. Right now, that's gone from a $1.8 billion business on a quarterly run rate to about $1.3 billion on the most recent quarter. So not really going to be a growth driver in the future, but the two segments that are going to continue to grow are mobility and these delivery services. Now compare these growth rates to a company like Lyft, and you can see that Lyft is still growing technically, but definitely not growing at the rate of Uber. And what this ends up doing is it creates a big differentiation between the network effects in their given networks. With the ride-sharing business, these aren't companies that own cars or even have drivers that technically work for the company. It's a two-sided market. So you need to have drivers to be able to either pick up people or deliveries, and you need to have people and things to deliver on the other side. The bigger the network connecting those two things is, the better the network is for both sides of that market. If you're looking for a ride and there's only 10 drivers in your city of 1 million people, that's going to be very difficult to operate a business. If there's 100 or 1,000 drivers in that same city, that's going to be a much more valuable network. So it's just going to determine where people go first to look for their ride. And I think it's become very clear that Uber has become the winner of that. It's become the place of choice to look for either a ride or things to get delivered. So things like Uber Eats. And that's a network effect that gets stronger and stronger over time. So success breeds more success in a business like this. And that's exactly what you see when you compare the revenue growth rates of Uber and Lyft. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. What has changed over the last few years is Uber's profitability. The company has really swung its way to not only a profit, but also positive free cash flow. And what is the reason for that? Well, this chart shows it right here very plainly. Uber's take rate, or the percentage of each delivery or ride, has never been higher, now in the mid to high 20% range. Going back to 2016, their take rate was in that 21% range. So one of the major changes that Uber has made over the last 2 or 3 years is just to simply take a bigger chunk of every dollar that's spent on the platform. Now, ironically, it's been able to do this at the same time that it's been able to attract drivers and customers. So this hasn't manifested in things like higher prices and people searching elsewhere for a ride. So it really has started to show the power of the business. And I think this is the big takeaway and the big change over the last couple of years. It's become a much stickier business as the network effect has gotten bigger, as the platform has gotten bigger, and they moved into adjacent markets, keeping those drivers even busier. So it's kind of a win-win for everybody, and they're able to take more revenue and actually turn a profit. So this has been the huge financial shift. And you can see this in the financial numbers when you compare Uber and Lyft. The first chart that I'll show has Uber's revenue in blue, net income in orange. So you can see lost a lot of money in 2019, 2020, even in 2022. But now that has turned into a profit over the past year. And it looks like it's going to be fairly sustainable. Free cash flow is looking even better, $2.3 billion over the past year in positive free cash flow. So this should put the company in a much more solid financial position. Lyft, a very different story. Here are the exact same metrics for Lyft. I talked about revenue growth earlier, but you can see that this net loss continues. And Lyft has also not been able to generate positive free cash flow. That puts a lot of pressure on the business and ends up being a downward spiral. And this is why we see Uber being much bigger from a revenue side, because it's a much more stable business financially. So this happens oftentimes in these what I call winner take all markets, where there's a platform or a network effect. You end up having one company that builds a bigger platform, and then that generates more power in the platform, which causes it to become bigger, which allows them to do things like raise prices and get more profitable and even bigger. Not only can Uber generate more revenue per ride, but they can have more rides than Lyft can. Just a phenomenal position for them to be in financially. Now that Uber has turned the corner, starting to make positive free cash flow, positive net income, I don't see any end to that. The only question for investors today is the valuation appropriate? I'll just go through a few of the metrics here. Enterprise value to sales on a trailing 12-month basis is 3.9. So that's pretty expensive for a company that is ultimately a technology company and is tied to those riders. They have to pay, and it's tied to the drivers that operate their system. So there may be a limit on the margins that they can have. That's why you don't want to pay too much for a company like this. Price to earnings ratio on a trailing 12-month basis is 131. Enterprise value to free cash flow is 63. If we look at a next 12-month basis, which is based on analyst estimates, so at least gives us an idea of where the company might be in the future from a valuation perspective. Enterprise value to sales is 3.3. Price to earnings still 66. And enterprise value to free cash flow is over 30. So yes, Uber is in a phenomenal position strategically. Great that that network continues to grow. Great that they're able to take a higher take rate. But it's also a very expensive stock. And that's really what I worry about right now, is our investors just simply paying too much for the stock. One thing that I want to point out long term is Uber does need to figure out what their autonomous driving strategy is going to be. They have a partnership with Waymo, but we do have other companies like Cruise, Zoox, Waymo, and then there's companies in Asia too that are developing this technology to have autonomous driving vehicles that could simply do exactly what Uber does without the driver and with a more efficient vehicle. So I think that's ultimately the threat that investors need to think about. That's one reason not to pay too much for the stock, but strategically and financially, Uber is doing extremely well. That's why we've seen the company perform as well as we have. What do you think about the position of Uber today? Is it a buy? Is it a sell? Love to hear your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.